This week, how older Americans' poor spending habits may disqualify them from getting a HECM in the future.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome back to the Industry Leader Update here at HECMWorld.com. There's a big shortage of monthly cash flow. Today, more Americans are broke. As of November, over 60% of Americans reported living paycheck to paycheck, with 20% reporting that they are now struggling to pay their monthly bills. According to Amber Carroll, Senior Vice President of Membership and Lifecycle Strategy at LendingClub.com. Older Americans who are now retired or are continuing to work are also feeling the squeeze, especially with inflation. Consider this: 14% of baby boomers, of those born between the years 1946 and 1964, have no savings cushion for unexpected expenses, most of which are now being financed on a credit card. And speaking of credit cards, more Americans are coming up short each and every month to cover their expenses, but that has not slowed their holiday spending. Perhaps you heard the shiny economic news in the media. Recent data from the Federal Reserve reveals a credit-fueled holiday shopping season, with revolving credit and credit card debt surging at an annualized rate of 17% in November. But now that the holiday shopping hangover has set in, consumers are receiving their monthly statements and also higher monthly minimum payments. That's an untenable situation for some, especially as most credit cards are charging interest rates, or APRs, anywhere from 25 to 30% or higher. If 60% of the economy lives paycheck to paycheck, as we've estimated, and a significant percentage of consumers tapped credit to finance their gifting, that means that, one, they've taken on even more debt that has been seen with the Fed's November report, and two, they're likely to feel a squeeze. Consequently, older homeowners with substantial home equity who find themselves over-leveraged with credit could be unwittingly reducing their potential chances of qualifying for a HECM loan, or reducing their proceeds very seriously. And that could jeopardize their approval should a lifetime expectancy set aside, or LESA, be required. The financial assessment is a key element for the underwriting of the HECM, or home equity conversion mortgage. And that protocol measures an applicant's financial capacity and their willingness to meet their financial obligations. And they do that by looking at the homeowner's credit history, payment history of property taxes, also homeowner's insurance, and then they look at the residual monthly income. That's the income that remains after all expenses have been paid. Now, consequently, those who max out their credit cards or other revolving debt with late payments or other delinquencies could be finding themselves required to have a sizable lifetime expectancy set aside that they wouldn't have had if they had not over-leveraged themselves with debt. Now, this account, the LESA, ensures that monies are allocated to pay for future property charges such as property taxes and homeowners insurance, and that mitigates the risk of a potential technical foreclosure or default. Now, the result is that the borrower will have fewer loan proceeds, or even worse, they find themselves short to close because of the sizable set-aside. But 2024 could actually be a year of opportunity for older Americans who do find themselves cash flow constrained. Now, a growing consensus of economists do expect that the Federal Reserve will cut interest rates repeatedly in 2024, perhaps in the spring. And that's good news, as the 10-year constant maturity Treasury rate, which in part does determine a HECM's expected rate and the starting proceeds available, typically leads the trend line for the Fed funds rate, as shown in this chart. Lower rates and relatively stable home prices this year would be a prime opportunity if it comes to pass, especially for older homeowners that need to eliminate their required monthly mortgage payments and boost their cash flow by tapping into a portion of their home's value. Now, what say you? Do you believe that we will see substantially lower interest rates this year? And how do you feel that seniors or older homeowners today are potentially disqualifying themselves from getting a HECM in the future? Speak your mind in the comments section below, and also if you'd be so kind as to share this video on your LinkedIn profile. Don't forget we have a YouTube channel where you can subscribe and also hit the notification bell. And each and every week we curate reverse mortgage news just for you, so you can stay current on all things reverse mortgage. That's HECM World Weekly. We now have a video podcast version as well, and audio listeners, you can find us on Apple Music, which used to be iTunes, also Spotify and Podbean.com. Thanks so much for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis here at HECMWorld.com.